The Labour Party has ruled out raising taxes for working people in the October budget, which leaves the middle class at risk. Keir Starmer has said that the October budget will be painful and that we can expect taxes to increase. I'm a qualified accountant with over 10 years of experience working for some of the leading UK tax practices. And in this video, I'll explain 3 taxes that Labour could realistically introduce. This is a follow-up video from one I made earlier in the year, which will hopefully provide more clarity on the changes that we might see. First up is an annual wealth tax on homeowners. When asked to define who working people are, Keir Starmer said that it's people who go out to work and who would struggle to write a cheque if they needed to. So a wealth tax could make sense because the working people that Labour have promised would not suffer increased taxes would most likely not have to pay the wealth tax. It's unlikely that Labour would introduce a traditional annual wealth tax on the value of your assets, because that would be a big administrative burden for the government, because they'd have to ask people to go out and get their assets independently valued, whether it's property, artwork or cars, and then they would have to independently verify those valuations. It would also make the UK a much less attractive place for wealthy people to live, and that could harm the economy. So it's more likely that a wealth tax would be tied to the value of land and property. So there was an interesting article written in the Telegraph which was titled "Labour may be plotting a devastating plan to make millions tax prisoners in their own homes." And the article says there's an influential body across the political spectrum saying residential property isn't taxed enough. So there's a good chance that the Labour government will target landlords, people who own second homes, and also people who sell their homes and make a big windfall. In terms of what the tax could look like, it would be most likely an annual wealth tax, but it could be linked to council tax bans. So think tanks have been urging the government to reform the current council tax system and to introduce new bans for more expensive properties, because the current property values are based on valuations that were done in 1991. And we know that homes in London are worth 6 times more than they were in 1995. So this could be a source of significant revenue for the government. The government could also look to impose a higher council tax charge on people who own more than one home. Another thing they could do is to introduce a mansion tax similar to the one that was introduced in LA in the US. LA introduced a 4% mansion tax on property sales over $5 million, and it made around $200 million in its first year. Arguably, something like this would impact property sales in London more than it would in the rest of the UK. And then they could just introduce a straightforward land tax, which would be levied on landowners. One of the big problems with a tax like this is that it could impact people who are no longer working and who have an expensive house. They may not have much cash, so they might not actually be able to afford higher council tax rates or another form of wealth tax. So it could force people to sell their homes, and it wouldn't actually help people get on the property ladder. Instead, it would just penalise the middle class and those people who are no longer working. The second change we could see is a stealth tax. This is a sneaky way of collecting more taxes because it's not a new tax and we won't see new rates and we won't see new thresholds. Instead, we'll see income tax and national insurance tax thresholds being frozen. And that results in something called fiscal drag, which means that as people's wages increase and they start to earn more money, they will be dragged into the higher and additional rate tax bands, which means that they will start to pay tax at 40% and 45% without actually realising it. Fiscal drag is something that is already happening because income tax thresholds and national insurance tax thresholds have been frozen until 2028. And it's expected that the government will make up to £34 billion by 2028 just by not increasing those thresholds. The government like it because it's an easy and effective way of collecting more taxes without necessarily announcing that they're making any big changes. And they can justify it by saying that the UK has the highest personal allowance, which is tax-free, out of all of the G20 countries. So they can say that the tax system in some ways is already quite generous. So what Labour will most likely do is to continue to keep those income tax and national insurance thresholds where they are. But that will mean that people who have fairly normal jobs, experienced nurses, police officers, will end up paying a higher rate of tax at 40%. And that higher rate tax band was never supposed to catch those people. It was supposed to catch the very wealthy people. So more and more people are going to find themselves paying an extremely high rate of tax. The third thing we could see is a change to the capital gains tax system. The government are expected to increase capital gains tax rates. So a capital gain is when you sell an asset for more money than what you paid for it, and then you pay tax on that profit, which is your gain. Usually the gain is on property or stocks, but it can also be on the sale of a business as well. For a basic rate taxpayer, the capital gains tax rate is 10% or 18% depending on the underlying asset. And for higher rate taxpayers, it's 20% or 28%. But there are also different reliefs that are available for capital gains tax. And that's what makes it such a target for Labour, because capital gains are taxed way more favourably than income is. So there's a lot that Labour could do there to bring up the capital gains tax system with the income tax system. According to research done by the University of Warwick and the London School of Economics, 68% of all capital gains come from the sale of businesses. They also found that nearly 75% of the people who make a capital gain are aged over 50. So any increase to the capital gains tax rates will have a disproportionately negative effect on the older population than the younger population. So there's a very good chance that Labour could look to increase the highest rate of capital gains tax to bring it in line with the highest rate of income tax, which is 45%. And that might mean that people delay selling their businesses. So there could be less transactions of people buying and selling businesses, which could make things quite stagnant. And that would have a negative impact on the economy. So that's a brief summary of what Labour could look to change with the October budget. Thanks for watching. Don't forget to subscribe if you haven't already, and I will see you next time.